From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 8th, 2025. Let's check the calendar. It's your last chance to eat some yummy deep-fried food on a stick this weekend at the Wisconsin State Fair. Or you can check out Greendale Village Days, or there's Jewish Food Festival Sunday and Monday in Mequon. Your first-place Milwaukee Brewers, the hottest team in all of baseball, are home the next 6 games. It's the Mets' turn this weekend, then followed by the Pirates. Okay, here we go with some international flavor today. A zoo in Denmark is inviting people to donate their small pets that they don't want anymore. The donated animals will be fed to the zoo's captive predators. Just to be clear, they'll euthanize a little Fluffy and little Tigger before feeding them to the lions and tigers and bears. Oh my! A 75-year-old Chinese man was asking his wife for a divorce because he fell in love with an AI woman. He saw her online. This is for the guys. Will we never learn? And finally, we're off to Sao Paulo, Brazil. A woman was found dead of a heart attack in the airport, and she had multiple bottles of booze in her luggage and 26 iPhones glued to her body. Police suspect she was a smuggler. You think? On the podcast today, we have Dave Sandstrom, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Teding.
Well, thanks, Max. A good week overall for markets, even if not for some of our smaller pets. The Nasdaq up 3.9%, closing at 21,450. The S&P 500 up 2.4% this week, up 151 points to close back near all-time highs at 63.89. And the Dow Jones Industrial average up just 1.3, although still a pretty meaningful 1.3, adding 207 points on Friday to close at 44,176 for the year. Nasdaq up 11.6%, the S&P 500 up 9.4%, and the Dow Jones Industrial average up 4.8%. Dave, probably a good place to start this week is just as we kind of put a cap for the most part on earnings season, now a little more than 80% of the way through, not a lot of businesses left to report. Hard not to focus, I think, on how strong earnings recovery has been relative to what had been businesses that had walked back those forecasts pretty substantially. Going back some time, we were talking about earnings forecasts in the low teens, and then it felt like, at least as we came through kind of the start of the season, that maybe it wasn't going to be quite so rosy. But here we are now, 80% of the way through. Things looking pretty strong on the earnings front.
You know, Kyle, it's interesting. Historically speaking, you know, we've always seen if you do get a rosy or aggressive earnings forecast, they typically do get walked back leading into those time frames, and you end up somewhere a little bit lower. So quite interesting to me to see such an aggressive forecast in my mind because of the fact that we're piling on top of a couple of years in a row with record earnings. So coming into this year with that 13% forecast, and like you said, due to a lot of unrest and uncertainty with trade wars and other things going on, just even some global uncertainty with geopolitical events, we saw those earnings get walked back in the 8% range, and yet here we are, like you said, 80% of the way through and averaging close to that 13% targeted number. I think it's fantastic given what's going on out there right now.
You know, I was encouraged most importantly by consumer discretionary stocks. We've talked at length about how the kind of consumer confidence numbers, consumer sentiment numbers have been a bit weaker than we would have hoped, that it was a sign that maybe the economy was a little softer. So dependent upon the consumer spending numbers are we that, you know, I think it was worth keeping a close eye, and yet some of the biggest surprises came from those consumer discretionary businesses. We'll talk a little bit later about some other signs in the consumer front, but at least from an earnings perspective, we came through the second quarter mostly intact. And then, John, as we kind of look at the fact that it's all about earnings and interest rates, as we've repeated for years, well, we've got a stock market that rallied pretty sharply along with that earnings growth, and now a forward price to earnings ratio sitting somewhere north of 22.5. It's tough to say at this point that stocks are cheap, even as we've got a pretty rosy outlook for earnings growth.
And earnings have looked really strong so far for Q2. And as you mentioned, PEs are still extremely stretched. We did dip below 19 a little bit earlier, back up above 22.5, like you said. Large growth at 155% historical PEs, large value at 120% historical PE averages. We're seeing the top 10 market cap companies in the S&P representing 40% of the total market cap. So there's lots of concentration. We are seeing some competition to stocks from bonds. The yields pretty close. We're seeing some of our intermediate funds, Kyle and I were talking, pushing 5.25 year to date. While you see some value funds, 7.5. It's really, how much do you want to pay for that extra risk? Looking at PEs moving forward, it starts to get a little bit risky.
I think that's a big part of the conversation is when we look at stocks right now, there is a lot of uncertainty out there. That's certainly always the case, right? That trying to forecast the future for business in general it comes fraught with all kinds of uncertainty, but especially with tariff policy now, we're seeing more and more in earnings announcements that corporate leaders are pointing to those tariffs as a challenge to corporate decision making. And it's one thing to say, here is the policy and it's going to hurt us, but here's what we can do to adapt. It's another to say, we don't know what the policies are going to be. And I think, Dave, that's a lot of what we're dealing with right now is this lack of clarity on a tariff front, even as we've gotten now some clarity on tax policy, a couple of other areas. But it's got to be hard for businesses to navigate that uncertainty of where should we go, which of the many paths should we pick as we look to a trade policy that certainly is going to continue to shift here.
Yeah, I would call it maximum uncertainty right now, and it was very, very noticeable in the GDP numbers in the last 2 quarters. I mean, look what we saw with companies front-running import numbers, trying to just stack the decks for themselves by bringing stuff into the country ahead of the tariffs, how that impacted the GDP numbers. And then, of course, the next month that kind of unwinds, and suddenly there's no imports, and the numbers swing the other way. So I think we're going to get a lot of skewed data during a time frame like this, just because of the unusual measures that corporations are going to take to try to navigate this. But you're absolutely right. This uncertainty it's going to be very difficult for corporate America to navigate this until they get anything. And you know what? Corporate America has always proven, we'll figure it out, but just give me the set of rules by which we're playing. Even if it's news that we think is bad news, corporate America will figure a way to survive and a way to get around it. So I think that's the big issue right now, that the uncertainty is there because they just don't know what's coming.
Well, and with a lot of the capital expenditure coming in the form of technology spend, whether it's commitment to artificial intelligence, whether it's just build out of more efficient production lines, I think the tools are there to navigate whatever that looks like. But again, I think if you don't know, okay, should I move my production facility? Should I move my manufacturing capacity from China to India? Should I move it from India to the U.S.? If you don't know where those policies are going to settle, you're left treading water when you probably should be swimming for shore. And I think if we're talking about the impact that has on economic growth, if we're talking about the longer-term delays that might cause for some of the really meaningful shifts we should have been seeing in productivity gains, this might set us back a couple of quarters in terms of some of that economic growth. It doesn't mean it's not coming, and certainly I think there's a lot of really exciting things happening in that CapEx space. It just means that maybe we need to be a little more patient about it. And as investors, I think that patience is key, right? That if you can find places to wait out the uncertainty, we talked about kind of the role that bonds play in portfolios repeatedly, and that, hey, you're actually being compensated pretty well to own them right now. Well, all of a sudden, maybe that is the piece of the portfolio you can fall back on as we navigate, Dave, to your point, that maximum uncertainty. Joel, we got some economic data worth pointing out. I mentioned earlier in the show that the consumer information, at least on the earnings front, had been more encouraging. We got a data point late this week on revolving credit. I think an interesting look at how consumers are feeling, not just by what they're saying, but now what they're actually doing with their credit cards.
Right, and that's a number that kind of cuts both ways. People. I usually see it as a sign of confidence that consumers have to spend their money without paying upfront for it, and they're confident enough that they can, pay off their credit card bills later. But it also is a sign of people being desperate, right? If they don't have enough money to pay for groceries and they're just spending down their credit card to do that, that's a bad sign. But the numbers that we've been seeing, it's been down 3 out of the last 4 months, and that hasn't happened that much. There's a graphic that I'll have in the show notes for the podcast that shows this consumer credit card debt outstanding over the last 20 years, and it's only really gone down over a period of time during the financial crisis and during the COVID pandemic, and now it's been down more or less since October. That's not that long of a period, but it sort of stands out in that graphic. So you have to start wondering and looking at other indicators to see whether, as we say, consumers usually say one thing and a lot of times they'll do another, but to see if indeed they're not spending as much money or that they're feeling less confident about their spending.
And we look pretty closely at delinquencies on debt. We look pretty closely at things like, disposable income relative to debt service. And all of those are showing signs that consumers are a little more committed to debt financing. We've seen some rising delinquencies, but all far below the levels that we saw, which were actually fairly low levels pre-COVID. Yeah, we saw a big decline during COVID in debt service and in outstanding debt and in delinquencies. And yes, it started to recover, but it's not in any way at some of those levels that would be more concerning yet, but worth watching.
One indicator that I looked at was the personal savings as a percentage of disposable income, which comes out once a month from the Bureau of Economic Analysis. And for July, that was 4.5%. So that was the saving rate. At just before COVID, that number was 7.5%, and if you take the average since 1959, it was 8.4%. So that's considerably lower. And just some of the anecdotes that we're hearing from some of the earnings calls, we're hearing CEOs and chief executives from Procter & Gamble and from Chipotle and Kroger's talking that they're seeing consumer behavior that reflects more of a concern, more of a conservatism among consumers as far as their spending is concerned.
Yeah, you and I were talking about the transition towards more discount grocery chains, for example, and the role that like Aldi plays now.
Right, they're the fastest growing grocery store in the country.
And I think that is really indicative of where consumers are trying to save a few pennies because they're seeing costs in other areas or fearful of seeing costs in other areas at times. And so, again, if you can move to the store brand label instead of the premium label, or if you can even move to maybe a slightly cheaper store to buy your goods, then you're going to find ways to do that. We had data on initial claims for unemployment. Obviously, we've been closely following the labor market, and so I think these kind of regular updates are a good way to just keep an eye on how are things going.
Right, yeah, that's something that we look at weekly, and we look at the 4-week moving average, so that kind of evens out some of it's a volatile number otherwise, and that's been down 7 weeks in a row, so that's good. It's the lowest it's been since April, but we had the labor statistics last week on the jobs report where it was looking that the hiring is getting weaker, but there's still hiring going on. Employers are still adding jobs. Just sort of anecdotally in my personal life, I'm knowing more people who have lost their jobs. And maybe that's just me, but I'm hearing more stories of that. So getting data to back it up, and that's a very important number when we're looking at consumers. And consumers are so important because 70% of GDP, of gross domestic product, is consumer spending. So if people aren't confident about having a job or keeping their job, they're not going to spend as much.
Joel, I'm wondering if, we're seeing according to jobs numbers last week, pretty weak hiring, as you just referenced. But on the other side of the coin, now we're seeing a real reluctance to let people go. And I'm almost wondering, we talked about the uncertainty that the tariffs are bringing into the equation. Maybe this is a sign of corporations saying, you know what, we're going to kind of play it in the middle right now. We're not letting people go, and maybe we shouldn't be hiring extra bodies right now because we don't know what's going on.
And Dave, there's the demographic aspect of that, because if we do let people go and things are better than we think, where are we going to hire those workers from when we need them?
Well, and clearly in a lot of institutions, there's been a pretty substantial brain drain just from losing some of our best and brightest to retirement. And so I think that's a pretty good reason why you want to hang on to all those best and brightest you can, because you're going to lose more of them to that retirement transition.
And that's another number that we got this week is on productivity. And that's something that shows us if we do lose workers, can we still have the output from our employers, with a fewer headcount or people working fewer hours. And that for the second quarter, the first look at our second quarter numbers, it looks pretty good. So far, during this business cycle, we're doing better than the business cycle that started in 2007. It's still below our average since 1947, but it's at a decent pace, and we still haven't seen a lot of the results from things like artificial intelligence.
Yeah, and I think it's so important to understand that just general rule of thumb, you grow your economy in one of two ways. You grow it by having more workers, or you grow it by making the workers you have, or maybe that you're starting to lose, more productive. And so if we can grow productivity at 2.4%, well, we're not seeing the influx of workers we once had, and we may actually see it go in the other direction. Well, you're going to get some economic growth, but you're going to get it from making those workers more productive. It's the only way we really have left, unless we drastically alter birth rates or immigration policies or one of the other ways you might see new workers come into the system. And so I think it's why that spending we were talking about earlier, the capital expenditures, is going to be so important to our ability to grow the economy, because absent businesses comfortable committing to technology spend, you're going to have a problem down the line as you continue to lose those workers to retirement or to whatever else if you can't continue to also make the existing workers more productive. We had data on the ISM Services Index. Services, such a bigger part of our economy than it used to be, and clearly still growing, but slowly.
Yeah, they survey supply managers for that number, and they're noticing a resilience among them, and the bottom line number shows that the service industry continues to grow, but just barely. And there's a lot of concern expressed in those surveys about tariffs and this whole the uncertainty that we were talking about earlier.
Yeah, I would love to have some clarity on what that actually looks like. And again, it probably will be a while still before we do, but some good data out there that I know we were talking about where tariffs kind of started in this cycle, where they were before, and where we've kind of settled for now. I don't think you yet have a good handle on what the end result will be, but I'm hoping over the next few months, businesses get some confidence that they know what environment they're operating in. It allows us to push back into that capital expenditure that we're going to need to really re-stimulate economic growth and to get back to kind of the next phase of the cycle, which is not, okay, we're going to sit on our hands for a little bit here, but all right, now let's get off and running again and figure out what to do next. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.